Welcome back. So, last time we dove into NRI tax benefits specifically for Gift City.
That's right.
Today we're widening the lens, looking at other common tax exemptions available for NRIs investing or earning in India generally.
Exactly. Beyond Gift City, there's quite a bit to unpack. Let's maybe start with long-term capital gains, LTCG. It's often a big area.
Okay, good place to start. LTCG exemptions, often tied to reinvesting, I believe.
Yes, that's often the case. The rules really try to channel that money back into certain types of assets in India.
Makes sense. So what about selling a residential house? What's the specific exemption there?
Okay, so if you sell a residential property you own in India, the long-term gain can be exempt. The main condition is reinvestment.
Reinvestment into another house.
Yes, exactly. You need to buy another residential house in India within 1 year before the sale, or 2 years after.
Oh.
Or you could construct one within 3 years.
Okay, 1 year before, 2 after, 3 for construction. Got it.
And crucially, it has to be just one new house. Plus, there's a cap now. The cost of the new house can't exceed INR 10 crore for the exemption. And, well, other conditions might apply too.
10 core cap, right? Seems aimed at keeping investment in housing flowing.
Precisely. Now, slightly different if you sell, say, land or a commercial building.
Right, not a house. What then?
For LTCG from land or buildings, you can get an exemption by investing in specific bonds. Think NHAI or REC bonds.
The infrastructure bond.
Those ones. You have to invest within 6 months of the sale. But here, the cap is lower. It's INR 50 lakhs maximum investment for the exemption.
Okay, 50 lakhs into bonds, another specific channel.
Yes. And there's actually a third LTCG route involving reinvesting in a house.
Oh, even if you didn't sell a house initially.
Exactly. If you sell pretty much any long-term capital asset, could be stocks, gold, whatever, except an existing residential house, you can potentially claim LTCG exemption.
How?
By using the entire net sale proceeds to buy or build one residential house in India.
Oh, okay, so sell shares, use all money to buy a house.
Basically, yes. And that same INR 10 crore cap on the new house cost applies here too, along with, other specific conditions.
Interesting. Lots of focus on reinvesting in property. Let's switch gears. What about interest income? That's relevant for many NRIs.
Definitely. Good news here, generally. Interest you earn on funds in your NRE account, fully tax exempt in India.
Okay, NRE interest is clear. What about FCNR accounts?
FCNR interest is also generally exempt. There might be some finer points depending on the specific account type or tenure, but largely it's tax-free here. Makes them attractive for holding foreign currency funds.
Right, very useful. Now the stock market, gains from Indian equities.
Okay, so for listed shares or units of equity funds or even business trusts traded on a recognized Indian exchange, there's a bit of relief.
How much?
Well, your long-term capital gains up to INR 1.25 lakh per year are actually not taxed at all.
1.25 lakh tax-free. Okay, what about gains above that?
Above that threshold, the LTCG is taxed. It was 10%, but be aware, for transactions on or after July 23, 2024, that rate is set to increase to 12.5%.
12.5% soon. Important date. And is indexation allowed?
No, that's a key point. This gain is calculated without the benefit of indexation, regardless of your overall tax slab. So the taxable amount might feel higher.
Right, no inflation adjustment on the purchase price. Got it. Are there any other common exemptions worth mentioning quickly?
Yes, a few others. Agricultural income earned in India is exempt, although technically it's included when figuring out your tax rate.
Okay, agriculture's exempt. What else?
Interest from any existing PPF account you might still hold that remains exempt. NRIs can't open new ones, though.
Right, existing PPF only.
Gifts from relatives, as defined in the Income Tax Act, are exempt from income tax. But do note there could be separate FEMA or regulatory things to consider there.
Always other angles. Anything else?
Minor things, too, like a small exemption, INR 1,500 per child, max 2 kids, and life insurance maturity proceeds are generally exempt.
Generally.
Yeah.
Are there catches?
Yes, usually if the premiums paid weren't too high relative to the sum assured, typically under 10% or 15% in some cases. But there are newer specific rules for ULIPs issued after Feb 2021, with premiums over 2.5 lakhs, and traditional policies issued after Feb 1, 2023, with premiums over 5 lakhs. Those can become taxable unless it's a death benefit payout. It really needs case-by-case checking based on dates and premiums.
Okay, so insurance needs careful review depending on the policy specifics.
Okay, lots of specifics there. Finally, tax treaties and deductions.
Always check if there's a double taxation avoidance agreement, a tax treaty between India and your country of residence. It could offer relief, maybe even exemption in India. You usually need to be a resident of the other country, of course.
And deductions,
Yeah.
like Section 80.
Yes, NRIs can claim deductions under Section 80 for things like certain investments, medical insurance premiums, but generally only if you opt for the old tax regime. The new regime usually doesn't allow for most Section 80 deductions.
So quite a landscape of potential exemptions beyond Gift City, as we discussed.
Definitely. But as you can tell from all the conditions and dates we mentioned, the specifics matter a lot.
Absolutely. This has been a general overview. Tax laws change. They have conditions.
Precisely. You really need advice tailored to your own situation.
Which is why we strongly recommend, if you're an NRI navigating this, please consult a qualified tax expert or legal professional. For that kind of tailored advice, you can reach out to Tax Exceller.
Yeah, think about how these exemptions might apply to you, and definitely keep an eye on the rules. They do evolve.